Yo, welcome back to Infant Investors, the home for all new and non-investors. I'm Curtis, and today got a quick video for you talking about how I'm planning to attack the coronavirus situation. Listen, we've talked about it in a number of videos. I've mentioned the 7 ways it can impact the economy, from production, consumption, tourism, etc, etc. And obviously we've seen a lot of volatility in the market over the past week. So knowing that and being armed with all of that information, I'm going to explain what I'm going to do differently with my portfolio when it comes to situations like the coronavirus that we're experiencing now, and if ever anything like this happens again in the future. So if you want to know more, like, comment, subscribe, help the channel get to 4K subscribers, and we can get the world of investing out to more people in a clear, simple and transparent manner. I'm reading this from The Guardian. Chinese shares dropped nearly 9% amid fears of coronavirus impact. Worth noting that this article was, or this post rather, was on Monday the 3rd of February. Now, as businesses in China remain shuttered and travel bans mount, crude oil and shares in Australia and Japan also take a hit. Stock markets in China have seen the biggest daily fall for 5 years as traders rush to sell amid continued fears about the impact on the global economy of the coronavirus epidemic. Now, the benchmark Shanghai Composite fell 8.7% on Monday on a new wave of negative sentiment that has built up for 10 days during the long market shutdown of the Lunar New Year. We talked about the Lunar New Year and the travel plans and how it was peak season for this to basically occur. The Shenzhen Composite was off 9.1% and dangerously close to the daily maximum permitted fall of 10%, after which trading is suspended. So if it was to have hit 10% of a fall, then trading would be suspended. You wouldn't be able to buy, sell stocks. It would all be blocked off, just because that is probably equating to hundreds of billions of value being lost in the market. We talked about how when Tesla went up the other day, 2 or 3% after their earnings, 4%, Elon Musk went up like 2.6 billion. So that's just one company, one individual. Just think about the whole of the Chinese index dropping. You know, you're talking losing too much value, basically, is the short answer of that. The losses were the worst on the Chinese market since 2015, although they pared back slightly later in the data, 8%. So basically it went up by 1.1%, then to 8%. It comes as the death toll from the outbreak rose to 361 and more than 17,000 people were infected. And Chinese authorities have reeled off a series of measures to tackle the market panic. On Sunday, they announced they flood the financial system with 1.2 trillion yuan, apologies if I got that wrong, which is 170 billion US dollars in extra liquidity, a measure designed to buy up securities from investors seeking to sell. So what the Chinese government, the Chinese authorities are doing is effectively, because the value is depreciating so much, they're now buying stocks. They're buying into the market in order to prop up the prices. You know, in some respects you can probably call that manipulation, but then you could also say from the other respect that actually it's fair value, because you know there is probably an unreasonable level of depression within the market for Chinese stocks. When we talk about nothing's wrong with the businesses, the fundamentals are probably very sound, and there's just such a panic that obviously a lot of these stocks are being sold. However, let's move to a more recent article, being today, and that's the reason why I wanted to wait a few days before actually making this video. Now, February the 4th, 2020, Asian markets improve a day after the coronavirus shocked Chinese stocks. So stocks in Asia mostly improved Tuesday, one day after Chinese markets experienced their worst session in years. The Shanghai Composite ended up 1.3%. It was the second day Chinese markets had to react to the worsening coronavirus since closing for the Lunar New Year holiday more than a week ago. Monday was the index's worst day since August 2015, Black Monday, when global markets were rattled by fears of an economic slowdown in China. The Shenzhen Composite Index closed 3.2% higher. Monday marked the index's biggest single day percentage drop since 2007. Monday's losses wiped out a combined, okay, we got the figure, 445 billion. Yeesh. in the two indexes stock value, 445 billion. That is ridiculous. So obviously the amount that they've injected over here, we can see that they injected 170 billion US dollars, is still, you know, what, about 2/5 of the full amount that that they actually dropped by. So in terms of manipulation, we can probably rule that one out. It's not going to do that much of an impact, but it's just going to create some extra liquidity, which obviously is going to be important. Now Hong Kong's Hang Seng Index HSI rose 1.2% today, while South Korea's Kospi rose 1.8% and Japan's Nikkei 225 edged up 0.5%. So what we can see is here on the 3rd, you can see how this is the massive impact. Chinese shares, the world is turning, you know, the world is crashing, whatever you want, whatever analogy you want to use. And then here you can see that it was literally a day later. It's kind of not a one-day thing, but things are starting to improve, things are starting to bounce back. And I believe that a lot of this bounce back was probably not even due to the government's extra liquidity, but people actually realizing, you know, actually we're probably selling off some really good businesses, and actually maybe now that things have dropped so much, is actually an opportunity to go and rebuy them, because, you know, we were a little bit hasty. Now this is where I'm going to get into what I'm going to do and how I'm going to attack this situation, because I wanted to run an experiment. So I wanted to run an experiment on how much money I could potentially make shorting the Chinese market after I heard that coronavirus dropped the stocks 9%. So on eToro, I did a virtual trade. I talk to you guys about paper trading all of the time and doing virtual trades just to test things out. You can then learn from that, and then when situations represent themselves, you can obviously know what you're going to need to do. So I did a virtual trade. This is not my real money. I want to make that crystal clear. As you can see here, virtual. This is not my real money, but I wanted to basically test something out just to see what would happen in this situation. Obviously, I wasn't investing or trading during the SARS epidemic, so I have no first-hand experience knowing what happens in these types of situations. And because of the type of person I am, I like to, you know, do things myself and try things out myself, because I think for me that's the best way that I learn. So what I basically did is did a short position after this article came out, and after I saw that the Chinese markets dropped, I did a short position for China 50, which is one of China's indexes, and I leveraged it. So I did about 5,000 and I leveraged it just to see what would happen. Would it continue falling throughout the week, and what type of return I would expect to see? And what you can see here is that I'll be losing money, and I'm losing money because the markets have bounced back quite considerably, and so because the markets are rising, I'm effectively losing money. So just to make that clear for those of you that don't know what shorting is basically betting that the market will go down, or betting that the stock will go down. Whether it's longing or going long is betting that the market goes up. 98% of investors long, they basically buy stock so that it goes up, but obviously some traders and some, you know, specific accredited investors may short things because they think something's going to go down, but there's obviously a lot of risks associated with shorting. So I went and done that with virtual money, and you can see how much of a loss that I'm basically making. And that's to show you that actually, you know, you can have all of this hype, you can have all of this hysteria, and what that's basically kind of informed me is I don't think you should be changing your strategy on a whim just because something as significant as this is happening. If you have a strategy in place, it's something personally you should kind of stick with. When I go to the Financial Times, it says stocks recover after deep coronavirus sell-off. Now this article came out today, I believe. Where's the date? The date is 24 minutes ago. That's how recent this is. Chinese benchmark index closes 2.6% higher, so that's on top of the improvements we saw here. It closes 2.6% higher following its biggest one-day sell-off in 2015. US stocks joined global peers and rallied on Tuesday, while government bonds fell. So typically we see an inverse behavior from bonds and equities as investors bet the impact from the deadly coronavirus will not be enough to knock the world economy off course. Wall Street's major bourses were all back in positive territory for the year, with the S&P 500 rising 1.5% in morning trade. That put it on course for its biggest one-day rise since early August, and added to the previous session's gains. The the Nasdaq Composite added 1.6%. Let me just say that again, just because I don't want something to be glossed over, because for me it's a really, really important point. It might not be to you, but to me it's important. To me it's important. Basically, Wall Street's major bourses were all back in positive territory for the year, with the S&P 500 rising 1.5% in morning trade. That put it on course for its biggest one-day rise since early August. Its biggest one-day rise in over half a year happened the day after the coronavirus drop. Now, that for me is very, very significant. That just shows that the coronavirus had such a big impact, and everyone then realized, you know what, this is silly. It's not going to actually change anything. Let's buy. And then not only did they buy, and it didn't just go up 0.5%, 0.79%, 0.9%, 1%, it went up 1.5%, which is the biggest one-day jump up in 6 months. So that's a significant level of jump. And what that's effectively telling me is that when these effective outbreaks happen and everyone starts panicking in the market, there is a bit of an opportunity to capitalize with people's panic. So when things do start to drop, rather than trying to short it like I did here, albeit virtually, what you could potentially do is wait until it drops, and then when you see that 9%, that 10%, that significant figure, that could be the time to start scooping up some shares, effectively buying the dip, and you might see, you know, some significant rises. I'm looking at my portfolio on my phone at the moment from free trade, and we talked about how much money that I lost on the Thursday, or how much money I was down rather, and I've made all of that back and some. So it just shows that there is the opportunity that when things are going down but the market generally is in an okay place, it's time to actually devote some time and buy. So when I go back to the purpose of this video, what strategy am I going to employ or engage when these situations happen? I'm basically going to do no different. If you saw my 2020 vision, you saw that I have 3 pillars to my strategy: drip, dip and crip. The crip pillar I don't really do that much with at the moment. I've got some Bitcoin, I leave it there. I have plans for alternative investments. I don't really do anything much. But at the end of the day, this is a whole full year strategy, so, and it's only 10% of that portfolio, so I don't really need to make all of my focus on that element, so to speak, at the moment. But the 2 things that I do want to focus my energy on is the drip and the dip. The drip is basically dividend reinvestment stocks, and the dip is high growth stocks. And what you guys have been seeing from my portfolio updates is that I have been acquiring high growth stocks. You've seen Microsoft, you've seen Apple of recent, you've seen me add Shopify, you've seen me add Uber, you've seen me add, who else have I added? AMD, you've seen me add, there's probably more that I've basically, Okta, PayPal. You know, I've added quite a few high growth stocks to really try and bolster this dip element of my portfolio. And these are the types of stocks that when the market has been gone down by 99% or whatever because of things like coronavirus, these are the types of stocks that I definitely want to be adding more funds to at the time. The other pillar, as you know, is the drip pillar. The drip pillar is my dividend. What country am I from? The dividend reinvestment strategy, and that for me is all about reinvesting into long, safe, good stocks. You could potentially include Microsoft and Apple into that, but I'm kind of including that into growth just because of the way they're performing recently. But I'm looking at a lot of my UK REITs and a lot of my UK stocks in this situation: my Sentiments, my Taylor Wimpey's, my Barrett's, my Avivas, my Legal and Generals, my Imperial Brands, those types of stocks. And in this situation, I don't really care what happens with the market. Coronavirus, no coronavirus, it really makes no difference to me. Whenever I have money, it goes into these stocks. If I have some spare change, it goes into these stocks. When I buy something on free trade and then it returns back to me like 13 quid, I don't leave that 13 quid in cash. I just put it into one of these dividend stocks. Any spare change I have, it goes into these dividend stocks. And what I'm basically trying to illustrate is the whole purpose of having a strategy is that you stick with it. You stick with your strategy and you learn from it. If you have a strategy and you don't stick with it and you constantly change and you constantly react and you constantly bend to all of these different news and outbreaks and alerts, then at the end of the year you might do well, but if you don't do well, it's going to be very hard to pinpoint and identify why you didn't effectively do well. Well, part of it is you kept on changing, but you wouldn't know where you've actually gone wrong. If you have a strategy, my recommendation is to always stick with it. If there are outbreaks like coronavirus, etc., hitting the market, then yes, there might be some buying opportunities, but I wouldn't go changing anything. I wouldn't go selling everything and getting and panicking and getting scared because things are falling. Me personally, I would be buying stuff. Obviously, to see the 9% drop, that showed that many investors was selling unnecessarily. When we talk about it here, you can see that so many investors must have been selling unnecessarily for that 9.1% drop, for that 8% drop, because of all of that fear and panic. But now we're seeing that stocks are recovering, highest one day rise in like the last 6 months, the last 7 months effectively. So me personally, when it comes to things like this, I'm going to continue doing what I've set out to do for the rest of this year. If I want to make a serious change to my strategy because of something major, then I may do so, but I definitely won't let outbreaks like this do that. And what my recommendation to you guys is that you guys focus on whatever strategy you've got and you continue doing that, and then when there are some buying opportunities, you take that as well. Listen, I hope you found that useful and I hope you found that helpful. If you did, get in the comments, like, comment and subscribe, and I will catch you next time with another investment video.